Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Wage growth is still elevated, but continues to moderate visibly, and profits are partially buffering its impact on inflation. The concerns that increased uncertainty and a volatile market response to the trade tension in April would have a tightening impact on financing conditions have eased. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release that is available on our website. So I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The economy grew by 0.3% in the first quarter of 2025, according to Eurostat's flash estimate. Unemployment at 6.2% in April is at its lowest level since the launch of the euro, and employment grew by 0.3% in the first quarter of the year, according to the flash estimate. In line with the staff projections, survey data point overall to some weaker prospects in the near term. While manufacturing has strengthened, partly because trade has been brought forward in anticipation of higher tariff, the more domestically oriented services sector is slowing. Higher tariffs and a stronger euro are expected to make it harder for firms to export. High uncertainty is expected to weigh on investment, but at the same time, several factors are keeping the economy resilient and should support growth over the medium term. A strong labour market, rising real incomes, robust private sector balance sheets, and easier financing conditions, in part because of our past interest rate cuts, should all help consumers and firms withstand the fallout from a volatile global environment. Recently announced measures to step up defense and infrastructure investment should also bolster growth. In the present geopolitical environment, it is even more urgent for fiscal and structural policies to make the euro area economy more productive, more competitive, and more resilient. The European Commission's Competitiveness Compass provides a concrete roadmap for action, and its proposals, including on simplification, should be swiftly adopted. This includes completing the Savings and Investment Union, following a clear and ambitious timetable. It is also important to rapidly establish the legislative framework to prepare the ground for the potential introduction of a digital euro. Governments should ensure sustainable public finances in line with the EU's economic governance framework, while prioritizing essential growth-enhancing structural reforms and strategic investment. Looking at inflation, annual inflation declined to 1.9% in May, from 2.2% in April, according to Eurostat's flash estimates. Energy price inflation remained at minus 3.6%. food price inflation rose to 3.3% from 3% the month before. Goods inflation was unchanged at 0.6%, while services inflation dropped to 3.2% from 4% in April. Services inflation had jumped in April mainly because prices for travel services around the Easter holidays went up by more than expected. Most indicators of underlying inflation suggest that inflation will stabilize sustainably at our 2% medium-term target. Labour costs are gradually moderating, as indicated by incoming data on negotiated wages and available country data on compensation per employee. The ECB's wage tracker points to a further easing of negotiated wage growth in 2025, while the staff projections see wage growth falling to below 3% in 2026 and 2027. While lower energy prices and a stronger euro are putting downward pressure on inflation in the near term, inflation is expected to return to target in 2027. Short-term consumer inflation expectations edged up in April, likely reflecting news about trade tensions. But most measures of longer-term inflation expectations continue to stand at around 2%, which supports the stabilization of inflation around our target. Turning now to our risk assessment. Risks to economic growth remain tilted to the downside,